everybody, welcome to a sharpening session, or the sharpening session for this weekend. Today is Saturday, so we do sharpening on weekends because we're not live in the markets. Obviously most markets, apart from maybe crypto markets, are closed, which means we have a bit more time to explain a little bit more concepts, explain things a little bit more, answer questions without the need to be placing trades and for you guys to be having to follow and catch up. We can just take our time a little bit and be a little bit more relaxed about it. So as you can see, the sharpening session, we have Q&A here. Q&A is the main point of sharpening, so I'll see you guys in the chat box, and you let me know if you have questions, if there's something that you want to make sure is covered. Otherwise, I have other things in mind for those that are watching the recording, or for those that might be watching just thinking it would be interesting to learn a random concept or a random thing that you might not necessarily bring to the table, but that might be helpful. So I will cover that. But again, just to say, for those of you that are watching live, if you are in the chat, you can ask me questions and I will answer them. That's kind of the point of these sessions, to make sure that you guys get the most out of it and that you understand what you need to understand and clear up what you need to clear up. So I'm just going to make sure I can definitely see the chat box here, so that we can definitely make sure that I can see what's going on. Okay, brilliant. So just whilst you guys are coming in, and again, any questions that you have, please put them in the chat box. I'm just going to make sure that I put the disclaimers up on the board there, so they should be highlighted. There we go, should be highlighting, there we go. So disclaimers are obviously important for you guys to understand, not just for legal reasons, but to just understand that when we go through anything, whether it's live in the markets and we're placing trades, whether it's the sessions that we do every morning, where we talk about the 5 major markets in the world and just talk about in general what's going on with them, whether we do sharpening sessions and it's not actually even placing trades or looking at markets, whatever we do when we do these sessions, we are simply demonstrating how we use the methodology, how we use the technology, how we think about things. It's entirely up to you guys to decide whether or not you ignore that entirely and do what you want to do, whether you take it on board entirely, whether you mold it into something else and you find something in between that suits you better, whether you trade it live, whether you trade it simulated, whether you don't trade at all. All those things are ultimately up to you to decide what is best for you as a trader. And you'll notice on my sessions, whether that's in the stock sessions, whether that's sharpening sessions, or if I have time to say it in the morning on the market commentary, that my main thing is, as traders, we need to combine subjectivity, which is us as human beings, with the objective methodology to make it be something that is more likely to work for us. Just because we might trade a certain methodology in an exact way does not necessarily mean that that's going to be 100% right for you. If the way you are as a person is maybe more conservative or less conservative, or maybe you are more patient or less patient, maybe you have more time or less time, maybe you have more. There are loads of different variables that will dictate which methodologies and which applications of methodologies will suit you best as an individual. Our job is to show you how we do things, so that you can then figure out from there, does that make sense? Is that something that I want to copy? Is that something that I want to incorporate? Or do I want to take pieces of it? The most important thing is that however you use a methodology, however you create a methodology, the best thing that you can do is make it objective once you've decided what makes more sense for you. So I'll explain that. That was kind of my plan to go through today, which is I'm going to apply it to different risk management techniques and different target placement techniques, and explain the pros and cons of each. So hopefully it's easier for you guys to figure out, is that going to be the way I do things, or am I going to do that? Or if I'm going to do both, when decide when I do both. So I'll explain that today. Questions if you want to. Questions. There's also this link here, tradewithufos. There we go. Once you go to that link, tradewithufos.com/Becky, you can use this part here to set up a free membership. Once you've got a free membership, you get loads of benefits, such as the newsflash that we send every day. You'll get emails with discounts sometimes to courses and things. You'll get recordings of our YouTube sessions sent to you directly. But one of the great things about having a free membership is that you can come down here, and once you're logged in, it's taking a second to move that. Once you're logged in, you can ask questions here. So once you're logged in, you can ask questions in a public environment, which means if you scroll down, there are people here that have already asked questions. You can see that there. People have already asked questions and the answers are there. So rather than you come and ask a question and maybe wait a day or two for a response, the answer might already be here. So you can use that link to find the answer, or to ask the question and then other people can benefit from the answer. So hopefully that makes sense as to why we want you to use those links. Because there is something more I need to explain. So we've said hello, so hello everybody. Again, just to reiterate, especially on these sessions, on all of our sessions actually, the more interactive you can be, the better. We want to make sure you get the best out of this as possible. If you're spending your time watching us and we're spending our time delivering, we want to make sure that that time is useful for you. So by all means, ask as many questions as you need, and interrupt and say, hold on, that didn't make sense, can you explain it again? Perfectly happy to do that. So that's that. So what that means is we are streaming in different places. So you might be seeing this on Facebook, you might be seeing it on YouTube, you may be seeing it within our closed coaching community. Now, what will happen is, in fact, I think it will say it in the next one. I'll do that in a second. What will happen is we will cut the stream to the free publication, so YouTube and Facebook, round about the halfway point. When we're doing live trading in the markets, we cut it after normally when we find at least 1 or 2 trades. When we're doing sharpening, then I kind of do it based on the questions that are coming in and based on the content as we go through. Sometimes it might be that we go the whole way through and we stream the whole way through everywhere. Sometimes we might cut sooner rather than later. It will change depending on the content and depending on what we do. It's not a set minutes, which means you'd be cut off mid-sentence or something like that. So we want to make sure, again, wherever you're accessing this, you get the best out of it. For those of you within the closed community, whenever we continue to watch it in that closed community, you'll have access to the rest of that video, and also access to more sessions as well. So again, this bit here is different. When we do sharpening, we go through different things, so we'll leave that. So what I'm going to explain now, because I can't see any questions coming in, again, you guys let me know if you have questions, happy to answer. But in the meantime, what we're going to do, I'm going to go to TradingView, and we're going to just have a look at the markets so that I can explain what I mean by different risk management techniques. First things first, actually, I think I'm going to just close that taskbar to give me a little bit, hold on 1 second, a little bit more room, there we go. Okay, so when we are looking at the markets and when we're getting into a trade, we have different ways of doing that, right? Our methodology, and I'm just going to sum it up very, very quickly. In fact, let's open a different layout. Let's do nailing FX as a layout, so we can see 2 charts. So we can just go through what the, in theory, what the what we're going to be looking at is, firstly, what our AutoClimate is telling us. That answers question number 1, which is, should we be buying, should we be selling, should we be doing nothing? That's the first question you should be asking yourself. However you trade, whatever you trade, whatever technology or methodology you use, that should be a question that you know the answer to, and that you have an objective way to answer that question. Should I be looking to buy? Should I be looking to sell? Or should I be looking to do nothing? That's question number 1. We use our AutoClimate app to help us answer that question. So if we have, let me just highlight the whole thing here. My mouse is being weird. Okay, there we go. Let's just highlight the whole thing. This is our AutoClimate app. So this is helpful because the different coloured dots will tell us where we have probabilities and therefore whether we should be looking to buy, sell, or do nothing. So if it's a thick blue dot, like in this random example that we're looking at here, if it's a thick blue dot, that tells us probability to the upside, meaning we should be looking to go long or buy. If it was a thick red dot, say one of these, that would tell us we have probabilities to the downside, meaning we should be looking to sell or go short. If it was a thin colour, or a thin dot, sorry, of either colour, say one of these or one of those, little bit harder to see, but that's kind of for a reason. If it's a thin dot, that's the Auto Climate app's way of telling us that we do not have enough probabilities either side, in which case do nothing. Better to do nothing than it would be to simply place a trade for the sake of placing it and end up losing money and wasting time as well. So with this particular example, let's look at pound yen, for example. Let's look at the pound yen, just so we can look at a nice clean chart. There we go. Okay, so let's take this one as an example. It might even be one that lines up, let's see. Not quite, but we'll pretend it does. So we have a thick blue dot, which would mean we would be looking to go long, looking to buy. We have probabilities to the upside. Where do we do that? Where's the best place for us to be able to get in and out of these markets? Now, why is that important? You might think, well, okay, if I've got probabilities to the upside, I'll just go long, I'll just buy. But buying right now, or whatever the price is when you happen to be looking at it, is an extremely subjective way. So we do need to combine subjective and objective, but that is a subjective methodology. We want an objective methodology that's molded to a subjective trader's profile. By simply buying at whatever the price is right now, because that happens to be the price that it is when you're looking at it, is buying based on something that's so subjective that it's unlikely to consistently make you profits or consistently work for you. You're also likely to find it more difficult and maximize your reward because you've simply bought in the middle of nowhere. That has no structure or no probabilities. It's harder to know where you would be proven objectively wrong, where you would be proven objectively right, because you're just randomly buying. So we do need to have that second question. If I'm going to buy, where do I buy? If I'm going to sell, where do I sell? Now, we use our AutoUFOs to help with this. So we have our UFOs here. We've got the bands that show on the side of price, on the price axis, and those show us the price values where we have a range where there are likely to be buy orders or sell orders. If it's green, there are buy orders. If it's red, they are sell orders. Now, why is that important? Because if you are looking to buy, it makes much more sense for you to buy where loads of other people are buying. And that's what the AutoUFO app is doing. It is identifying where there are big stacks of buy orders or big stacks of sell orders. So if I'm going to buy, in order to beat the amount of sell orders that are coming in, I need a lot of buy orders. So we want to be buying where there are other buy orders. We want to be selling where there are other sell orders, which is what help us with that. To objectively show us visually on the chart, this is where that range of orders are likely to be. And then it's up to us to then use that to decide on our trade. Now, there's an extra element that we use as part of our methodology, and I'm going to come back round to saying why it's okay for you to maybe pick and choose, and we'll talk about that. So the other element of our methodology is to also combine our EMA, exponential moving average. So EMA, it says up here EMA 9. So an exponential moving average, clues in the name moving average, it's a line that moves with price. It gets an average of what price has done for the last 9 candles in this case, because it's a 9-period EMA, and gives you an average of that. It's exponential because it puts more weight towards the latter data than it does towards the older data. So either way, we have an average that is showing us where price has moved averagely over those last 9 periods. Why is that important? Because everybody in the world has access to EMAs. Pretty much. Any platform in the world, any broker in the world, you're going to have access to EMAs for free on your platforms, really easy to download, or they're just there, right? This is an app or an indicator that's already in TradingView. You didn't have to download it, you didn't have to set up a membership, it's just there. So, because it's something that is very commonly accessed, it means that lots of people use it to help them with their trading. Not just retail individuals that are trading, but also people like hedge fund managers or fund managers in general. They're going to be using moving averages as well to help them get in an average price, right? So what happens in the theory is that when price is above, let's say here, so when price is above, mouse keeps going, above the EMA, that when it comes down and hits the EMA, the theory is that we should be buying. That's what people would be doing. That if price is above the EMA and then it comes down and hits that line, you buy at that point. If price is below the EMA, so let's say like here, mouse is being strange here, there you go. If price is below the EMA and then comes back up and hits the EMA, in theory, people would be selling here. So that's a common use of that technology. So again, why is that important? Why are we combining this? Because let's say we have buy orders here within this range. We can see that because the AutoUFO app has told us this is where there are buy orders, right? So we want to be buying where there's other buyers. And there's buyers here because there's a stack of buy orders that we can see from our AutoUFOs showing us that that's where they are. On top of that, let's assume, it's not, but let's assume that the EMA from the bigger time frame was also within that. Let's say the EMA was here. If the EMA was there, then we have buy orders coming in just because we have a stack of buy orders that could be there for any of us picking up. And we also have buy orders coming in because if price comes down and hits the EMA, a lot of people are going to be buying it. So we've got buy orders and buy orders, and then our buy order goes in with that. So the more buy orders we have, the more likely it is to beat the sell orders and push price upwards. If we want to buy, we want price to go up. If we were selling, we'd want price to come down. So if we're combining these two elements, then we can add to our probabilities that price does go up, which is what we wanted to do if we buy. So we use those two elements to increase our probabilities. Now I said I would come back round to saying how we could make this subjective or why you might pick and choose. Now part of that is you might be saying, or you might be thinking, hold on, that means if I want those two numbers to line up, I'll be honest with you, it doesn't happen very often compared to just buying at the EMA, which happens regularly, or just buying any random buy UFO, that happens more regularly. The fact that those two variables have to combine around the same price point is less likely to happen, which means you have less trading opportunity, which for some people is frustrating. For others, they would rather have less trading opportunity if those opportunities have higher probability, meaning they're more likely to work, they're more likely to make you profits. So again, we trade one for the other, we exchange one for the other. To reduce risk and increase probability, sometimes you have to decrease the amount of opportunities that you have there. If you're going to increase the amount of opportunities you have, normally that means you'll have to decrease the probability and decrease or maybe increase your risk a little bit, your risk exposure. And again, neither one is right or wrong. It's okay to be on one side or the other. It's okay to say, you know what, I'm not going to use UFOs, but I'm going to use EMAs and Fibonacci retracements. So those two things have to combine. Or I'm going to use UFOs and Fibonacci retracements. Or I'm going to use UFOs, EMAs and Fibonacci retracements. Or I'm going to use breakouts of support and resistance as well. Whatever it is, it really doesn't matter. There are hundreds of ways to trade profitably. There are loads of people that make money in the markets that do very different things from each other. They're not necessarily trading using the same technology or the same methodology, which can be confusing. It can make people think, what do I do? There's so many people out there talking about different things, using different technologies, trading different markets on different time frames. How do I know, as somebody that might be new to trading, what to pick? How do I know what to do? And it means that we change what we do all the time because we don't know, and we go with what the expert is telling us, and they're all telling us different things. So it can be overwhelming, it can be confusing, but in my opinion, it's amazing. It's amazing that there are so many different ways of trading the same markets on the same time frames and making money in different ways. That you can decrease probability but increase opportunity and still be okay, still make money. You can decrease opportunity and increase probability and be okay and still make money. You can combine many different variables. You can be very simple. Again, we exchange one thing for the other. The less variables you have that have to meet a criteria, the higher the probability that it doesn't work out. The more variables that you have that where it has to meet certain criteria, the less opportunity you have, as in the less likely you're less likely to see all those variables come together, but you're more likely to see it work in your favour. And isn't it great that we can choose based on how we are as people as to which combinations of variables work out best for us or make more sense to us? The more important thing is to not change what we do all the time. is to not say, sometimes I'm going to use Fibonacci retracements, sometimes I'm going to use UFOs, sometimes it has to have the EMA, sometimes it doesn't, sometimes I'm going to do breakouts, sometimes I'm going to do visual, literally just use a visual skill to identify where I'm getting in. I'm going to use chart patterns, I'm going to use different indicators, crossing over moving average. Based on when you're around, based on how you feel about risk tolerance, based on how patient or impatient you are, which are things that only apply to you, that may not apply to any other trader. So once we've then figured that out and we've gone, okay, we are going to, in the case of the trade with UFOs methodology, we are going to trade only when we have the EMA being enveloped by a UFO, and we're going to use these numbers now for our entry and stop. So let's assume it's not, this EMA value does not fall within that, but let's assume for the purposes of demonstration that would be the trade that we take. Again, there would be different things that you would layer on top of that. So for example, question number 3 is going to be exactly where do I put my entry, stop and targets. Techniques that will help you out with that. So what I'll do is I'll explain 1 or 2 on the pros and cons, and then I'll stop the simulcast and I'll go into the private room and continue there. Now, okay, so let's have a look. When it comes to this UFO, let's say, and what I do, by the way, this will be, for those of you that use Fibonacci retracements, sorry, I have changed this. The reason I've changed it, I'm just going to change the colour there. The reason I've changed it, you'll notice here that usually your Fibonacci retracement lines will come with something like that, right? So you'll see loads of different lines within your Fibonacci's. I take them all out and just use one. So that the numbers that I'm given by my UFOs are fixed on the chart because I've drawn them on the chart. Understand, UFO stands for unfilled order. So as orders get filled, meaning we've got a big stack of buy orders that are waiting, unfilled, they're just waiting there, and then price comes in and they get filled, there's less buy orders there because they've been able to buy, right? That then means that there are not enough unfilled orders anymore for the app to continue to tell you that they're there. So the app will update when there's no longer unfilled orders, which means that it can then be difficult to figure out where did I get in, where did I get out, where was my entry, did I get filled, did I not get filled. So I choose drawing tools to make this a little bit easier. That's my personal preference. Now, in terms of coordinates, in terms of the actual prices, now the green highlighted boxes here, these are the ones that tell us what the UFO price range is. So where there are buy orders between a price range. So from 151.496 to 151.383, the app is saying between these two numbers, between these two price points, we've got buy orders there. So I need to use those numbers to then help me figure out exactly where my entry and stop will be. So what we're going to do to give us a little bit of wiggle room and to increase probability of getting into trades is we're going to add a little bit of space here. So if the top number of the UFO is 151.496, I'm just going to round that up to 151.50. So it's a nice round number, it's to the closest pip. And then I'm going to add a couple of pips. Again, just to help combat the ability of actually entering a trade. So it's going to be 151.52. That would be my entry. And again, I'm using the objective numbers given to me by the UFO, and always for entry on a long, rounding up and adding 2 pips every time. So it's objective and it's consistent. You could round it up and add 3 pips, round it up and add 5 pips, round it up and add 1 pip, or just round it up. That, again, it doesn't matter. What matters is that you are consistent with that. If you sometimes round it up by 5 pips and sometimes just round it up, sometimes add 2 pips, then you're changing variables regularly and it's going to be hard to see whether that's working for you. Again, just to talk about the pros and cons of this. If 151.52, let me just click that for now so it goes there. If that's my entry, I'm more likely to get filled. So this is why I do this, to increase probability of getting filled. So if price were to come towards me, let's say it didn't quite hit 151.496. it hit 151.52 or 151.50 and then goes off. I've then missed the trade if I didn't add a couple of pips and have my entry a little bit higher. The downside to that is I'm now increasing the distance between my entry and stop. I'm increasing my risk, which then means that in order for me to make relative profits, price has to move further to hit those profits. So let's do the stop here and I'll explain that again. So the stop number, the reference value that we get from the UFO, the objective number that we get from that is 151.383. Now because this is a stop on a long, I'm not just going to round that down, so it's 151.38 and then I'm going to minus 5 pips. So that's going to take me to 151.33. Is now, if we do that, there we go, that there is now the difference stop. And notice that those two numbers, going to get versus if I put my entry exactly at to get into the trade. And what I'm also trying to do by adding a little bit of wiggle room to the stop is, so as price comes down, if it comes down, let's, just because of spread, just because of a bit of volatility, it goes to 151.36 or 151.37. Pip below what that stop would be if we just took that number exactly as it is, and then turn and went up from there. So I want to give it a little bit of wiggle room so that I have room to be very slightly wrong, right? To if it's not exactly accurate, I'm still in the trade. So that's why I've added either side. Now the downside of that is that now the difference between my entry and stop is 29 pips. If I've done that maths right. It's less than that. Okay. 19 pips, that's the difference between my entry and stop, which means, let's say I want to take a 1-to-1, just draw that there, then my target has to be 19 pips away. If the difference between my entry and stop is 19 pips, and I take a 1-to-1 target, it's got to be 19 pips away to the upside. If my entry was 151.496 and my stop was 151.383, well, that's only, what, 11 pips? Which means my target would only need to be 11